Looking at your notes, you've been looking particularly at some of the 10-day moving averages and how many stocks are below or above that level and what it tells you for where we are in the pullback.
From a tactical level, first of all, you have to have, from a tactical level, when more than 90% of stocks are trading below their 10-day moving average, and at the close, according to Bloomberg, it was only 8% of stocks were trading above their 10-day moving average. When it gets that washed out, you're within earshot of some kind of bounce. It may not be the next day, but when I went back and I look over the last few years, you're going to get a lift. So you don't want to sell into two really bad days like that. This has been happening underneath the market for the last couple of weeks. And what typically happens is it ends up in the indices because the average stock has already done it and they finally get around to hitting the big guys.
Where do you expect the S&P to end the year?
Our target for this year is 2950, so it's plus or minus. But honestly, you know, at this point, it's a tactical call. What we're really focused on, Morgan, is our target for next year is 3350. I think I'm too low. The guys printing the money globally told you the game plan. So we come on TV and we try to tell you why it's good or bad or should or shouldn't. The guys printing the money told you that they're going to print more of it if the data got worse. Well, guess what? The data is getting worse. And even Janet Yellen last Friday said that the Fed is too optimistic on the U.S. economy. So I don't want to fight the Fed knowing the news backdrop can create volatility.
Isn't that a message you would expect the market to intuit? In other words, you shouldn't have to say, hey, guys, this is what's going to happen. So why do you think the market is fixated elsewhere?
It happens each time, Mike, because the data gets so much worse. So we're and I've said it so many times, people are sick of it. We're in the third mini recession of this cycle, the last 10 years, where the manufacturing sector from global chaos creates the perception that you're in a mini recession. What that has done is created like a bear market in the S&P, where you go down like close to 20%, and then the 10-year bond yield doesn't bottom for months after that. So the last fourth quarter was discounting the slowdown that we're having now. The 10 years reflecting that. So in our opinion, it's time to be offensive.
So what would you be buying on a day like today?
History shows, we love opinions. I'll tell you what the data shows. If you believe that the 10-year has bottomed and we're not going into recession, which I would not believe given the way that credit is acting and the stimulative effect on housing and autos. But bottom line is, if you think that the 10 years bottom, which I do, history shows you want to play offense. You want to play aggressive. You want to use weakness to the opportunity. You want to be in consumer cyclicals, financials, industrials, infotech, even the more cyclical sides of infotech. I'm not scared to call for a correction. I've done it many times. I didn't think we'd go down 20% twice this cycle. This isn't one of those times because the entire global central bank community is trying to figure out a way to make it work, right? And when that happens, you don't want to bet against that kind of liquidity coming in.